switch some money from one mutual fund to another, say from a regular plan to direct plan, or from a poor performing fund to a better performing fund, how do I go about this? Should I invest in one shot? Should I switch in one shot? Should I do it gradually? Also, if I have a lump sum with me, how do I go about investing it? Should I do something different from what I'm already doing? These are questions that many investors have, and Shashank Kumar had asked these questions yesterday, so I thought I'll make a video on them. The questions are there. So the first point to remember is that when you're switching, so there are two ways, there are two possibilities where you have to switch from one instrument to another. One possibility is the rebalancing that I talked about a few days ago, where you are going to switch some units from an equity fund to a debt instrument, maybe a debt fund, or you are going to switch from a debt instrument to an equity instrument, maybe it's stocks, maybe it's a mutual fund. That is one situation. The other situation is what we are looking at today, where we are switching from one, let us say, one stock to another, one mutual fund to another of the same category, one equity fund to another, maybe from a regular plan to direct plan, or of the same fund or regular plan from one equity fund to direct plan of another equity fund, or your poor performing equity fund direct plan to another direct plan of another fund which you think is better performing at that time. In all these cases, the switch should be done instantaneously in one shot. In the case of rebalancing, I think it's easy for people to understand, because you are resetting your portfolio. You want your portfolio to have this much asset allocation. The asset allocation has changed, you are resetting it. So the reset has to be done immediately. In the case of switching from one type of, from one equity fund to another, maybe regular plan to direct or whatever. So when switching from one equity fund to another or one debt fund to another, also the switch should be, in my opinion, instantaneous. There is no advantage or disadvantage of switching from one fund to another gradually, or doing what is this called, STP, or some things like that. Don't do all that. The reason is because your money is in a equity fund. It is already invested in some stocks. You are essentially taking that money and putting it in some other stocks, in another mutual fund. That's all. The problem people have is, will compounding get affected? Will there be a break in compounding? First of all, there is no compounding in equity. You can see my video on that. Because compounding means growing nicely like that. In equity funds, your growth will be like this. That's not compounding. That's nonsense. So the risk is there before you even switched. So it's like, basically the simplest example I can give you is, let us say you have a gas stove with two burners. If you have a pan boiling in one burner, you are just switching on another burner and shifting it. Why should you put another pan in the burner and gradually take some water and put it there? What is the great benefit? This is also fire, that's also fire. You're just shifting it, right? So what's the great? There's no difference. So there is no need for you to wait for a few months, or just switch out and invest in one shot. If you are changing from regular plan to direct plan, you can switch at a click of a button in the AMC portal itself. If you are switching from one fund to another fund, redeem, wait for the money to hit your bank. Then when the money hits your bank, immediately take all that money and buy units in the new fund. Do not look at the market. Do not wait for a right time. You will be wasting time, and it will only affect your wealth from actually growing. Don't overthink the situation. Just switch. That's the answer to the first question. Second question is, I think I've already talked about this, but it's okay to talk about it again. What should I do if I get a lump sum? First of all, we have to define a lump sum. A lump sum is something that is much greater than what I put in every month. For example, he has talked about 15 lakhs. So lump sum means if I am investing 20,000 rupees a month and I get 15 lakhs from somewhere, that's a lump sum for sure. If I am investing 2-3 lakhs a month and I get 15 lakhs, is that a lump sum? Maybe borderline. I don't know. So that's how I would like to define it. There are many other ways you can define it. So the question is, where should I? There are two questions here. Where should I invest the lump sum? How should I invest the lump sum? Where should I invest the lump sum? The answer is quite simple. Wherever you are investing now, you invest the lump sum. I am assuming that you are investing with a plan. So if you do not have a plan, don't worry about the lump sum. Let that sit in the bank or sit in the liquid fund. Don't get overworked about it. You sit and devise a financial plan for yourself, either on your own or you can consult a fee-only financial advisor from my website. They work for you for a fee. They are SEBI registered investment advisors. They will they will look at your goals and tell you what to do, where to invest, what is the asset allocation. The same thing you can do also yourself. It's not a big deal. Once you decide, for my retirement, I'm going to need 60% equity, 50% fixed income. For my child, I'm going to need 40% equity, 60% fixed income, etc., etc., etc. You make these demarcations. Then out of that, let's say 15 lakhs, you will decide, okay, I'm going to put 5 lakhs for my child's future, 10 lakhs for my retirement or any other way. And then that 10 lakh, out of that 10 lakhs, 60% you put in equity, 40% you put in fixed income. Out of the 5 lakhs, 50% you put in equity for your child's education, 50% you put in, 40% you put in equity for your child's education and 60% you put in fixed income again for your child's education. That's it. You have your asset allocation plan, decide your asset allocation and invest exactly as per that. Please, my suggestion is do not add any new instrument that you do not have any prior experience. This is my suggestion, but don't. If you are, sometimes you may want to. There are many other possibilities. For example, you may always want to have purchased a house for yourself. Then use this lump sum, provided you take care of your existing investments and so on. But don't get into a new investment. I certainly would not recommend buying any kind of land or commercial shop unless you are very clear about what you're doing. Many people are not, but they just have the dream to do it. So that's the where to invest the lump sum. How to invest the lump sum? See, if you have been a very experienced market player, you can just take it's like having a big piece of bread and you want to eat it. You can just bite into it or just have the bread, take a small piece and start eating. So similarly, that's your lump sum. Take a piece and put a little bit into the into fixed income and equity the way you want. You do it gradually. It's better to do it gradually. If you do it gradually in both, see what happens is, let's say 10 lakhs, I want to put 6 lakhs in equity and 4 lakhs in fixed income. You can just put that 4 lakhs in fixed income straight away. That 6 lakhs, many people will be worried about putting in equity. So they will gradually do it. How gradual is another problem. That depends on your experience. My suggestion is to invest a little bit every week. That will give you, or manually, don't start SIPs and so on. That's painful. Or STPs, whatever. Don't do all that. From your bank account or wherever the money is, every week take a little bit, just like the bread, take a piece and put it in equity. Take a piece and put it in equity. And finish it off within 6 months preferably. Don't delay it any longer. Otherwise, what will happen, there will be some skew in the asset allocation because you have put that 4 lakh immediately into fixed income. That's it. It's quite simple. Please don't break your head about it. Another question is regarding the first question about switching. Some people say there will be exit load, there will be taxes. How do I know how to calculate and so on? See, first of all, don't rely on online trackers or your AMC to give you this capital gains or tax information and whatever. Don't think about mutual fund transactions in terms of money. Think about mutual fund transactions in terms of units. On this day, I purchased 100 units at this NAV. On next month, I purchased 90 units on this NAV. Another month, I purchased 80 units on that NAV. So you go back to the first ever purchase you made, then you say, okay, today the date is this much, the NAV is that much. This date is more than 1 year from the date of first purchase. So whatever gains that comes from that first purchase of 100 units will be long-term capital gains. What is the capital gain for that purchase? Write it down. What is the capital gain for the second purchase, third purchase, fourth purchase? So you find out how many of those units are, first of all, free from exit load. Second of all, how many of those units give a capital gain equal to or less than 1 lakh. So then that much money is tax free. You can pull it out. If you say no, this is for people who are extremely worried about taxes and so on. I think for most people who want to switch with little money, then the full purchase will qualify for at least most of the units will qualify for long-term capital gain with a gain of less than 1 lakh, so it will be tax free. So don't worry too much about it. You may have some 20 units or 30 units which qualify for short-term capital gain at the time of switching. If you're so worried about paying short-term capital gains tax, wait for it to become long-term, then you can switch. My suggestion is get rid of it. You have a bad apple in the barrel, throw it, your apple becomes cleaner. It's easier to manage it. That is the lesson is that, or the moral is that please think in terms of units, don't think in terms of money. Then the whole process of switching, taxation, calculation of exit load, everything becomes simple. You can do it immediately on a piece of spreadsheet. You can just, it will take 15 minutes to do the calculation. With some interest, if you have, it will be done. That's all. So that's what I wanted to say in this video. If you have any questions like this, please comment below. What I want to know is what are the actual problems you are facing when you invest. I don't want to, can I invest here? I am holding this fund. What should I do? That kind of questions don't interest me. Questions like that, these are real problems. That's what I want to address in this channel. So thank you as always for listening. I'll catch you later. Bye-bye.